Brenda Hagen as Livestock Price Insurance Program Coordinator with the field with AFSC. And with that, she's been there with market field analyst and acting coordinator for a 2.5-year period. She works out of the Wainwright and Lacombe offices to ensure that, in fact, they have the support of that program. Prior to AFSC, she graduated from U of A, majoring in agriculture business management, and has worked in different facets of the industry in Europe and more recently in Edmonton. Involvement in agriculture as a career is a natural fit, as she's been raised in a commercial cow-calf operation in central Alberta. And I think you still are in an operation, are you not?
My parents are.
Your parents are. Okay, I'm going to pass it over to Brenda.
I've been involved in the cow-calfonomics for the last 2 years, and we've been talking strictly on cattle price insurance program. I felt like it was a good time to add in a little bit more value into my presentation and to maybe give some more context to the tools that are used with the forecasting for the cattle price insurance program, but also what programs you as producers can watch and also participate in as additional risk management tools to the cattle price insurance program. So I'm going to get into 4 different tools, and I really want to have you keep in mind that this is not me trying to explain how to use the tools. It's me explaining what they are and how they work. And what I really want you guys to take home is to know that you need to watch the prices, be informed, and be ready to act. So with that said, please don't get tied down into the details of some of the short hedges I'm going to explain, but just know that they're existing. They're also, knowing this information is what will keep you competitive in the industry. So with that, I want to do a little bit of risk management considerations before I get started. So as mentioned throughout the day, there's increasing volatility in the market. Of course, we know that. The problem is, how are we going to manage it? So we need to have some tools that we can use because we know this volatility is here to stay. Now again, I put up there that Canada is a price taker, and maybe a better word for that is we're integrated in the North American market. So we have less influence on the prices that we can set as the US does. So I don't want to say price taker, I'm just going to say integration in the North American market. But with that, it comes with some risks. Being north of the border, we also are exposed to risk, which includes the prices of our commodity, but also the currency and the basis risk. Now, basis has already been explained to you today, but I want to stress how important it is. It's becoming increasingly important. It's always been there, as well as the currency risk, of course. But now that we've got the different impacts that are coming into our market, like cool, we need to know what basis is doing. We need to know what it's projected to potentially do in the future, and we're going to need to know how it's going to impact our long-term prices. So that said, with those three risks coming into our market, you could say we're almost at a trifold increased risk to what our U.S. counterparts are facing. And then, of course, the markets can move extremely quickly. So what I want to do is show some ways to look at the markets and how to find these prices and know what the future trends are doing to make those opportunities work for you. And when you see the opportunity, that you need to act on it, because it's not going to last forever. So a few considerations on the risk management side is to hedge means to protect. So basically, when you're hedging, you're transferring risk from your cash position as an owner of a commodity or the cattle to someone else. Now, a true hedge you could think about as if it's on the futures market. So you as a producer would be transferring your cash risk to someone in the futures market. But risk management in general sense can be considered as transferring your own risk into the future cattle markets to someone else. So that would be even the feedlot if you're doing a forward contract. I will talk a little bit about the futures, and to do that I need to have you guys make some assumptions with me, and that's that there's concurrent movement of the cash and the futures market. So in a perfect world, they all move together. That said, of course, we all know that in the real life things aren't perfect, but the magnitude will still be the same. Basis risk, again, it's becoming increasingly impactful, and risk management is ensuring there is minimized loss on the cash market by offsetting risk somewhere else. Perfect world, a gain and a loss are equal. Keeping that in mind, we'll go through the tools that I have ready to talk to you about. So the first one is, of course, the Chicago Mercantile Exchange futures contracts. Second one is a derivative of futures, and that's options, which are also available on the Chicago Mercantile Exchange. Third one being the cattle price insurance program, and fourth one being contracts, whether it be price or basis. But the thing to keep in mind is, of course, there's tools available, but none of these are a silver bullet. None of these will be able to perfectly manage all of your risk, especially with the different sectors you're involved with. So of course, maybe the CME futures is going to be more applicable to the big backgrounders and more of the feedlot guys. Cow-calf producers, you might want to do a combination of 3 and 4. I'm saying that there's combinations that will make probably your best risk management because they will all kind of tie off differently. So know about them all, watch them, know what's available, and then be ready to act. So a futures contract. Well, what is the futures market? Well, basically it's price discovery and it's a price driver because what it's trying to do is forecast prices out into time. So that's basically our price driver for the underlying cash market. It can be further defined as where buyers and sellers meet to trade contracts to make or take delivery of commodities through standardized futures contracts. So standardized, the futures, is by determining quality, quantity, location, and delivery. But of course, price is still left open because that's the discovery. That's the point of the futures market. So we have to be able to have people on the futures market trading apples to apples. So we standardize contracts, but we still have that price discovery open. And that's where our risk comes in. So a futures contract has to be offsetting position, so there has to be a buyer and a seller. So a seller would be taking a short position, a buyer would be taking a long position. So now, again, don't get tied down into the details, but just know that the futures market is basically a paper market. It's price discovery. And the change in the price for that futures contract for the day is the consensus of the buyers and sellers that are participating in that contract as to what they think that commodity is worth. About 2% of all futures contracts, I believe, are actually delivered. So keep that in mind, knowing that it is a paper market that's forecasting out in time to what your commodity will be doing when you're ready to sell, assuming that the futures moves in tandem with the cash market. So I said they're standardized. So there's specifications of each contract that you can participate in on the Chicago Mercantile Exchange website. It's a fantastic website. I encourage everybody to go. But that said, the couple of points to keep in mind is there is contract specifications for size, and for feeder cattle, that's actually 50,000 pounds. So you have to trade a contract that's equal to 50,000 pounds of feeder cattle on hand. And they're available 8 months of the year for settlement, but you can trade them year round. I'm not going to get into the details, but know that this is where you can go to find more about it. Also on the website is the quotes that are traded daily. So you can go to the cmegroup.com and go under the agriculture commodities and find feeder cattle futures. So this is a snapshot of what the quotes were doing for the time that I took this picture. As you can see, you've got your different contracts that are available to you and then the details that have been traded that day for that contract. So you can see that any given time, 1 month will be up and another month will be down. That's because people are participating in this market, buying and selling contracts, and they're making a consensus to make a deal between a buyer and a seller as to what the price will be. So keep in mind, this is a good place to go. Some people have this bookmarked on their computer. Some people wake up every morning and get there, but know that it changes too. So don't just expect it to be that way as soon as you see it in the morning and it'll be that way, the same thing at night. But one thing to keep in mind is to learn a little bit more about it and do more of a visual sense of it is to click on that chart button right there. That'll bring you to a chart that looks like this. And Anne kind of explained what her chart meant, and so I'm not going to get into the details, but look at this as if you can see some trend lines and maybe see where the pricing opportunities could have been. And then from there you can gauge as we go into the future, as you keep watching these graphs, where other opportunities may be as well. Now, keeping in mind, I've been talking a lot about feeder cattle contracts. We also have to consider our currency, So currency is also a traded commodity, and I have a chart for that here. Again, it's moving. It's something that we have to keep in mind because it's one of the 3 risks that we have as a Canadian cattle producer. So I want to talk about a classic hedge, but I want to actually preface this a little bit as yes, I'm going to actually show it as if it's using a short futures, but in the perfect world, everything moves together, like I said. So you can think of this as actually a risk management diagram. So you're going to set yourself a target price that you want to get for your cattle out in the future point in time. That's going to be what we call your hedge price, but also think of that not necessarily in the terminology, but a target price. So now if the futures market starts to move up in the true sense of it, your futures value is going to go down because as a producer, you wanted to manage your risk against the price going down. So you took a short position. Therefore, if the futures start to go down, if your futures price starts to go up, your futures value goes down, but your inventory value goes up. So you have cash profits and futures losses. So if the lower futures price starts to head the wrong direction, you're going to have less value on your inventory, but a greater value on your futures position. So maybe I should erase that word futures and I should put your risk management strategy, because as you move to the left side of the graph, left side of the graph, you're going to make sure your risk management will have more value, but your commodity cash on hand will have less value. So they should match each other. But now, as the futures or the cash price start to move higher, your risk management is going to have less value to you, whether it be futures, whether it be forward contracts, whether it be whatever, even CPIP, it's going to have less value, but your inventory value is higher. Therefore, you're always bringing yourself back to your hedge price. And that was your target. So that's the kind of nuts and bolts of it, but I use this diagram as actually a short futures position. So let's get into it a little further. So we're assuming that you guys are background in cattle and that you're going to be taking a position on the futures market. So how that works is you're going to be participating in the Chicago Mercantile Exchange. You're going to sell a feeder cattle futures contract, which requires you to post some margin and some fees. If the feeder cattle futures go up, then you have to buy that same contract back as an offsetting position at the higher price and have actual cash loss, because you have to make up that cash to buy that position back. But you have the opportunity to sell the cattle at a higher price. So then if the feeder cattle futures go down, you can buy that contract back at a lower price, therefore you get value in it, but you have less of a market to sell into. So again, it's that offsetting principle that your risk management is setting your target price. Your risk management will have gain if there's loss on the cash side. Your risk management will have a loss if there's gain on the cash side. Now, I mentioned that there is another thing called options. This is my second tool. I really don't want to get into this too much because I feel it's maybe a little too detailed than what I want to intend for this presentation, but I have to acknowledge that it's available. So what it's doing is an option is a derivative of the futures, and it gives you the right but not the obligation to buy or sell something, in this case, the futures contract. So it gives you the right to participate in the futures market at a specified price on or before an expiration date. Now this is another thing to kind of watch, but know that you have to pay a premium to buy an option. But that also doesn't force you into the futures market immediately. It gives you the option, the right, but not the obligation to participate in it at a certain time frame in the future when the target that you've set is reached by the futures market. So there's buyers and sellers on this side too. The buyer pays the premium but has the right to participate in the market. That's going to be your hedger. Your seller of options is going to be receiving the premium, and he has an obligation now to that buyer. He's the speculator. So you guys as producers, 99% of the time are going to be the ones that are considered buying an option. There is also two different types. You can call it from the market or put it on the market. People selling cattle into the market are going to be more interested in the put, and that gives you the right but not obligation to go short the future. So that means that you don't want the price to fall. A quick discussion on actually doing a short hedge. So you're going to buy the put option, you pay the premium. Feeder cattle futures go up, you're out the premium, but you have the cash market. If the feeder cattle futures go down, you get to participate in the feeder cattle futures market at a higher price than what is available at the time that you jump into it, but you have to sell your cattle at a lower price. So it has a little bit of your downside risk managed. It's managing your downside risk. It's leaving your upside risk just at the premium cost. Now I'm going to get into our third tool, and that's the cattle price insurance program. This is the one I know the best, and it can be considered as a made in Alberta put. So what we've done is we've taken the need for a risk management tool for Alberta producers, and we've made it applicable to you guys. So we've tried to capture all the risks that you've got, price, currency, and basis, and wrap it all up into the one product, so you don't actually have to worry about doing your price risk management, your currency risk management, because the thing that I probably missed to tell you, and this is the probably most important part, actually participating in the futures market, you still have your basis risk completely open. So like I said, I feel like you might be getting too much into the details of the futures market, but just know that go there and watch the prices. Watch how they move. This is where the feedlots are participating. This is how you're going to stay competitive in your marketplace, knowing what they're actually seeing and forecasting their future prices out to be for the cattle they're buying from you, to know how to be competitive and negotiate. Anyway, back to cattle price insurance program. We're providing protection against an unpredicted decline in weekly Alberta cash prices over a defined period of time. So we're essentially letting you set yourself a floor price, and that's by purchasing coverage level through our premium tables. So that's establishing yourself that line there. So how it works is if the cash market ends up being higher when you're ready to sell the cattle or your policy is expiring, because they're supposed to be at the same time, you're going to sell the cattle for the higher dollar and you're going to be happy. You're going to go home happy. You'll have paid us the premium, but you'll have been able to sleep at night because you know that you've managed your risk from the downside. And as that bottom bullet says, there is the upside price potential open. So it's not tying you to a specific price, it's setting you a floor price. And as the cash market drops at time of expiry for this policy, the theory is you're going to be able to only have that market to sell into, and it's fallen from when you had expected it to be when you bought the insurance. So therefore AFSC pays the difference between the cash market that's existing when the policy expires and where you set your coverage level. The theory is to top you up that much difference from where you expect it to be to where the cash market is, because the theory is that you're selling into this cash market right now. This is the difference that AFSC will pay as your indemnity. Again, our coverage includes price, currency, and basis. We developed this, it was brought to us by basically the Alberta beef producers. After BSE happened, it took us a couple years to get it rolling, but it's intended to match all of your risks so that it's a made in Alberta product, because we want to have it for your own risk. So to do that, we have to match our coverage to reflect your Alberta risk, but also our settlement. So our settlement is taken off of the local cash price and not actually based on the actual price you sell your cattle for. So then we're standardizing the program basically. Our top coverage level that we're offering, we offer this Tuesday, Wednesdays, and Thursdays. Top coverage level is offered at 95% of the forecasted value. So we have to look at forecasting our prices, and our source for that is the Chicago Mercantile Exchange. That's the price discovery method that we're using to then relate it back to your prices that we're offering on the CPIP premium tables. That said, it's an insurance product, so we offer 95% of it, and 5% could be considered basically the deductible. There is no minimum purchase or settlement amounts. There's a 4-week claim window, and there is some specified purchase and claim hours. So the CME you can trade basically anytime you want to. The CPIP program is kind of based on some resourcing and staffing that we've got, so it's available during business hours basically. And you have to be 18 years of age or older, you have to own the cattle for 60 continuous days, and you have to be a producer in Alberta. That makes it relevant for you guys, so we're eliminating everybody that's trying to speculate, and therefore it's a producer-funded premium, and also it's a great program for you guys only to use. So we have broken the program into 3 different segments basically, and that's to cover off the different production types that go on within Alberta. So we have programs that cover off calf, feeder, and fed. Those are broken into basically weight ranges, but those aren't inclusive. So you could purchase coverage if you had, say, 700-pound cattle. You can still participate even though it's not necessarily reflected by the numbers I have up here. But like I said, we have to offer our forecasted price to you guys. So where do we get that? We have to rely on the Chicago Mercantile Exchange. Again, it's the only way we can try to predict what the future price is going to be. And that's why I stress so much that it's important to know how to watch the futures, to know how relevant it could be for your future price, and to know even if we're on target too. But then, of course, we have to make it Alberta relevant. So we also take a forward-looking currency and a historical basis off. So I talk so much about basis, and you're probably wondering, well, how the heck do you forecast basis? But what we do is we use historical, because the best way to predict the future is to look at the past. Not the best way, maybe, it's probably the only way right now. And then, of course, we offer this coverage level for you out in time. And for most of the programs, it's 12 to 36 weeks into the future. Calf is a little more seasonal, and it's 16 to 36 weeks, basically. So you purchase it in the spring for settlement in the fall. So that's the coverage. So now we're going to assume that you saw our premium tables. Actually, here's our premium table from yesterday. This is probably actually a better fit to put in right now. So we offered premiums Tuesday, Wednesday, Thursday. I pulled the premium table from yesterday. It shows you what we're offering as coverage levels out into the future. So even we got just yesterday, being a Tuesday, we got our 36-week policy on the books, and that's for August for feeder cattle. and it was up to 154. Now our prices come out at 130, like I mentioned, so before I got up here, and I was totally paying attention to the other speakers, I promise. I checked the prices and it was actually 156. So it's even moved up a little bit more. So that's important to know that it's driven by the futures. The dollar probably dropped a little bit too. It's been moving around quite a bit lately. And we're pricing these 3 days a week. You have to buy the premium table as it comes out that day because we're making it as timely as we can, trying to match the way the futures move, bringing it all together into the 3 different risks so you guys can buy off of it for that day. So I need to go back to my settlement slide. So we're assuming that we've purchased a policy, now we're ready to settle it. So what we're looking at is using the local cash market. We have to standardize the program, so we're taking into account for the calf and feeder program, auction market data. So we're not actually making you participate with giving us your sales slips actually when you've sold the cattle. There's no obligation to sell the cattle if you decide to retain ownership because you don't like the prices. You'll still get an indemnity payment. The thing to keep in mind though is we have to standardize it. So we get local cash market, 23 across the province, and for the Fed program we actually use the CanFax producer reported data. And we do some data cleaning basically, so what we're trying to establish is the average price, average quality steer in Alberta for that week of expiry for both the calf and the feeder program. That's what we compare to your coverage level to determine if the cash market's fallen or not. So let's say you're participating with AFSC. As a feeder cattle, you're going to buy the feeder program because you're buying some grass cattle. So as a rancher, you're going to buy a CPIP policy. You're going to pay us the premium. AFSC is going to sell you that CPIP policy, and we're going to receive the premium payment. If the Alberta cash goes up, you're out the premium, we retain the premium, but the cattle go to the feedlot at a higher price. If the Alberta cash goes down, AFSC pays you the indemnity, and you receive the indemnity, but of course you've still already paid us the premium, so it's always kind of that net premium. The indemnity is net premium, but it's still that value to you because the market's dropped. But unfortunately, have to sell the cattle at a lower price. My fourth tool is forward contracts. Now, of all the 3 tools that I've just told you, there's costs associated with all of them. Forward contracts is the only no-cost solution to risk management, but no upside price potential. So what essentially you're doing is by signing a contract is agreeing to delivery with another person that's going to take delivery, but you've specified price, specified quantity and quality, and the delivery period, of course. So that's basically tying you into a forward contract. I don't need to explain this, you guys all know about them, but there's no upside price potential. There is basis contracts available, and that's really handy for Alberta producers as well because, like I said, there's few tools besides CPIP that can actually lock in your basis. So some are offering basis contracts, and that then gives you the opportunity to leave the commodity risk open, but you've got your basis tied in, which may be increasingly important as we move into this cool unknown. So now you're going to say, now what? Great, you told me 4 tools. What am I going to do with them? Well, I want you guys just to have learned about them, to know how to watch them, and to know how they're both could impact your decision making and how they can benefit your operation. But what I've done is to summarize, I've built them all into benefit and limitations. So I'm just going to go through them individually again as if to show you how they can both work and not work necessarily. So back to futures contracts. So some benefits is that you can eliminate your price and currency risk, but you'd have to do them separately. But you can do them both. It's flexible and it's a very liquid market. You can also get a higher price too, because as I said, the CPIP coverage is at 95% forecasted level. Your futures contract, you can obviously, if you're participating, are getting 100%. So it has a little more maybe pricing opportunity that way, but there's a lot more risk. The limitations to these is your basis risk remains as a Canadian producer. There's margin requirements, time needed to watch the markets and stay abreast with what's going on. It requires expertise and discipline, and there is the contract sizes. So if you're not actually selling 50,000 pounds of feeder cattle, maybe a futures hedge isn't exactly perfect for you because you'll either be over-insuring or over-hedging or under-hedging. But the big thing is discipline, because you can see at any given time, maybe if your position's moving in the right direction, you're gaining $20,000 on your futures contract. It's pretty tempting to cash out right then, but then you basically lift your head and you're completely open to the cash market again. So it's really, it's a beast, I'm not gonna lie, and you need the discipline. Options, basically the same coverage. You can minimize your price and currency risk. You have upside potential, they're tradable, and you have the ability to get a little more sophisticated in some of your risk management by using them to do some strategies. The limitations are basis risk remains. Hedge account needed, same thing. Time, expertise, lack of liquidity sometimes. Again, something to keep in mind that you would need a broker. Cattle price insurance program, the benefits to this one, price, currency, and basis all wrapped up into one. Little discipline needed. Basically, it's the ultimate of discipline because once you've bought your policy, you are tied to that policy at that coverage level until it expires. So you don't have to worry about it. You don't have to watch it again. You just have to know what it settles at, so then you know what indemnity you got. There is no minimum purchase or settlement amounts. It's a simple program. It's easy to execute. Your upfront costs are known because that's just your premium, and it's effective in all border situations. That's really important because we guarantee that if anything happens at the border, we will still honor those policies that are outstanding. Limitations to the program, of course, it's a little less flexible. We offer you premium, we offer you coverage levels with a premium associated with that day. That's what you take it or leave it. That said, you don't have to really worry about it. If you like the price and you've done a break even and it's profit level for you, go ahead and buy. There is threshold limits for the bigger producers, which we can push through if we need to. And then we do look at the historical basis. And so sometimes people can consider that maybe a non-traditional forecasting methodology, but the way we're doing is we're including a spot and a historical component to our basis to forecast, and therefore maybe not exactly the same as something that Canfax would do, but still the best representation we can figure out to manage that basis risk for you guys, so you guys don't have to worry about it. And of course, restrictive purchase and settlement hours just due to staffing and the risks associated with keeping the program as timely as we can for you guys. And then delivery contracts, a few benefits and limitations here. You guys know more about these than I probably do, but benefits are that you can get price, currency, and or basis risk wrapped up depending on the forward contract offered to you. You know your price, delivery, date, and buyer. So these ones are the least cost and least flexible, but most known for your actual local cash price. So it's a bit of a spectrum. I would say the forward contracts are a really good way to manage some of that risk. If you're comfortable taking that contract, just knowing that if the market rallies by the time that your contract comes due, you're not going to be able to capitalize on it because you've already tied into that price as signed by the contract. There's no discipline and no cost. Limitations, non-tradable, no upside price potential. There is discounts. So you're going to be signing to know, you need to know what the fine print is within these because there's going to be some discounts for quality. There's going to be discounts for weights, depending on what you've intended to have for your sale weight. So keep in mind that that will bring you back off the price that was originally negotiated a little bit because there will be discounts. And the one big one that I think sets this apart from the cattle price insurance program is the force majeure. So you'll see in forward contracts that there will be a clause within any forward contract that says if there's a market disruption that basically closes the border, they have the right to deny that contract. They don't have to keep it outstanding and actually pay you for the delivery of your cattle. They don't have to take delivery because there's been such a disruption in the market that they can refuse it. Whereas the CPIP, it's guaranteed in all market situations. And there is uneven availability. Of course, these are a one-on-one negotiation and agreement, so it depends on who's willing to take delivery and if you can catch them at the right time to know if they will offer you a forward contract. So that's a quick and dirty of 4 different tools. And if I can send you home with one message from this presentation, it'll be that there is many tools to choose from. We need to get you guys to understand that you need to build a toolbox for yourself based on your individual objectives and goals. All tools have benefits and drawbacks, so you need to find which combination or which one will best suit your needs, knowing that there's no silver bullet. There is resources available to assist in learning about how to watch the futures because I think that's really what I want to drive home. Know that there's basis risk, know that there's forward pricing mechanisms, and know how they can affect your opportunities and your future marketings of your cattle. So watch the futures market. So resources could be the Chicago Mercantile Exchange, some really good knowledgeable employees within ARD, and then of course for the cattle price insurance program, resources within your local district office or within myself for the cattle price insurance program. Any questions? So the question was if I could just explain how we get to our coverage levels on the premium table. So what we're doing is we're making it as timely as we can. So we have to take the most forward-looking price data we can get and break it down into a usable product for you guys, which is CPIP. So we have to take a look at the forward pricing mechanism available, and that's the futures market. So that's our starting point. So we're looking at the forward contract that's traded on the futures market for the feeder cattle that matches our expiry dates. So that's an American forward-looking price. So then we also have to take into account the currency. So we also look at a forward-looking currency to match our expiry dates as well as like the futures contracts. So once we get those two together, we basically have ourselves a forward-looking Canadian price. And then we take off our forecasted basis, and by forecasted basis, it's basically a combination of the spot and historical 3 years for feeder cattle. That's what we have to, well, it's adding the basis on, but we're always at a negative basis, so we're subtracting our basis off, which is the difference between basically our trade available to us and the US equivalent trade. So that's always at a deficit, and right now I think Ann quoted maybe a negative 30 basis. Could be about a 26 basis too. It's just cool spreading us out quite wide from where the US counterparts are trading their feeder cattle at. So once we take that basis off of there, we now have a 100% forward looking price for different policy lengths. So as you can see, we price 12 to 36 weeks. So we'll have a forecast for each one of those. Now, as an insurance product, we offer you 95% of that. So this number right here is 95% of our forward looking price for August, based on what the futures, the currency, and the basis is telling us. That said, once you get to August, if it's anything below 154, that's indemnity for you. So there's no deductible after that. Like once you buy, it's straight 154 because we've already taken that off. Does that answer your question? Okay.
Cow-calf side of that, steers only?
Yeah, you can insure steers or heifers, but the data is based on steers, and as well as the feeder program. It's based on steer only because we don't know the end use of the cattle at that point in time, so we want to standardize it even more so. Yeah, it is. It's straight numbers of what the amount that you want to insure, just knowing that we're comparing it to a steer price at the end of it, basically.
So you sell your calves, you get 12, 20 cents under on your heifers.
Mm-hmm.
Does that affect the insured price?
Not at all. So before you bought the insurance, we would have just kind of maybe had that conversation to know that your heifers will be back from your steers. And that as long as you've insured your heifers at the equivalent price that you expect the steers at the same weight to be, then you'll be fine, as long as that spread stays the same from when you bought the insurance to when you're settling. So we're not insuring against a spread that widens for steers to heifers, but as long as there's a strong correlation between steers and heifers and the market movement in tandem for both of those, then you're covered, as long as you insure at the steer level. I think I'm out of time, but I'll be here after, so come see me if you need.